What is the loan to value ratio when it comes to getting a mortgage? The loan to value ratio when it comes to getting a mortgage also might be considered what is your down payment. Now, at the end of the day, the down payment, when you're talking to your loan officer at the very beginning of the process during pre-approval, it's probably going to be a big part of the conversation, right? You're going to say, hey, I have X amount for a down payment. I want to buy a house that cost Y amount. And then we do that math and we say, okay, your loan number is going to be Z amount. So if you're buying a house that's 500,000 and you want to put 100,000 down, you're going to have a loan amount of 400,000, and then that's going to translate to a loan to value, right? So that difference that you're buying down, that down payment of 100,000, that's your equity when you close, and then your loan amount is the percentage to that total purchase price of 500,000, right? So that's the very beginning stages of when you're talking to a loan officer about what loan to value is. Now, it gets slightly more complicated when you start thinking about an appraisal. Now, when an appraisal happens on the property, ideally speaking, it appraises for at the purchase price or more as a consumer, right? That means that you're getting a good deal. That means that at the end of the day, the house that you're buying is worth what you're paying for based on an appraised value or an opinion of value from an appraisal. Or it's worth even more. Maybe it's worth 520, 525, 550, so on and so forth, right? And you're getting it with a little bit more equity from that standpoint. Now, from the perspective of the loan to value, if it comes in over the purchase price, the loan to value is still going to remain the same at that spread of whatever your down payment percentage is compared to your loan amount and the purchase price, right? So that's going to ripple effect into if you're doing 10% down, 15% down, and your purchase price, and I'm going to go to a more even number, your purchase price is 100,000 and you're doing 10% down, your loan to value ratio is 90%. So you have 10% equity built in there, right? Then from that other standpoint, if it appraises at 110, from a lender's perspective, you're still at 90% if you're putting 10,000 down. Your purchase price is 100,000 and it appraises at 110. You do have that extra equity, but it's really not going to make a difference in terms of mortgage insurance, interest rate, whatever risk characteristics that we're looking at from the standpoint of coming up with all of your terms. You're still going to be at that 10% bracket or that 90% bracket. You're not going to get that extra benefit. Now, the downfall of that same math is it goes in the opposite direction as well. If it appraises for 95,000 and you're buying it for 100,000, you're trying to put 10,000 down or 10% down, you're going to be at 95% loan to value if you have a loan amount of 90,000, or slightly different. I'm doing just quick math in my head, right? So you're going to lose a little bit of that value, even though your purchase price is 100,000 on contract and it appraised for 95. That loan to value ratio is going to be skewed based on what the original contract was. And then that could go even worse from the standpoint if it appraises at 80,000 and you're buying it for 100 and you're trying to have a loan amount of 90,000. Now you're underwater with loan to value. Your loan to value ratio is actually above 100%, right? And it's probably going to be nearly impossible to find a lender that's going to go above 100% on the purchase price. So really what you want to look for when you're having conversations with your loan officer, with your realtor, is having a good basic understanding of what your down payment is, what the value of the house should potentially come out to be, how to make an offer, and any language you might need in the appraisal from the standpoint of the contract, whether it's appraisal gap language because you're willing to spend a little bit more than what it's technically worth today, or the opposite. You need language protecting your appraisal to say, hey, if I'm buying your house for 100,000, it needs to appraise for 100,000 or more, or it doesn't make sense for me, right? Because then if it appraises for 80,000 and you don't have that type of language in there, you really could be at risk for the contract and your deposit, because now the seller's expecting you to try to make up that difference to make your loan work. And if you don't have that extra money, then that's something you might have to have a conversation with your realtor on what you do from that standpoint, right? It's been very prevalent in the market the past few years, just because the market's been expanding and appreciating so much that houses have been going under contract for above list price and sometimes above what they're actually worth in an appraisal market, because the appraiser is looking at history of the market. They're not looking at current trends as heavily. So you might be buying a house for 100,000, you might be paying 130, it might be worth 100,000, and you're really paying 30,000 in future value, because once you close at 130, that kind of sets the market for that neighborhood a little bit, and it kind of keeps going up and up. That's how values keep increasing, and then eventually your house should be worth more unless the market heads the other direction and a new house closes for 110, 90, so on and so forth, right? So the value of the house is always dictated by what's happening in the market, and then the loan to value of the house is always the lesser of the two evils, purchase price or appraisal. If you appraise higher than your purchase price, we're going off purchase price. And if you appraise lower than your purchase price, we're going off appraisal to come up with that loan to value. And then that ripple effect has an impact into your qualification, interest rate offered, your mortgage insurance if you're doing a little bit less than down. That's why, again, in the recent market, if you're doing 30, 40, 50% down, you're doing a really big, large down payment, there's wiggle room into your loan to value before it really impacts your mortgage, which makes it more attractive to the seller. So if you were one of those buyers that's been winning the past few years, saying, hey, I want to buy your house, it's listed for $100,000, I'm paying $130,000, but I'm only getting a loan at $50,000, I'm putting down this big chunk, it could appraise for $90,000 and not really cause an issue, because then we still have plenty of equity there as a lender to say, hey, even though you're buying it for $130,000 and it appraised for $90,000 and you're getting a loan for $50,000, we have plenty of meat on the bones that the risk of your loan isn't bad, right? So from that perspective, then it's your choice to say, hey, well, I'm okay paying $130,000 because I'm gonna live here for 30 years or something like that, right? So you have a justification to why you're paying more than what the current value is from the standpoint of appraisal. And it could be that it's a competitive offer, you really wanna be in that neighborhood, you're finding value in that difference from that standpoint. But the counter to that is if you're putting 5% down and you're buying it for $130,000 and it appraises for $90,000, then the numbers don't make sense. And then you're going back to the drawing board, which is why that characteristic wasn't looked at very heavily in recent times. But essentially, that's the loan to value ratio. That's what the conversation you should be having with your lender during pre-approval. So you have a good understanding with your lender and then also alongside your realtor to make sure you're making strategic offers in the marketplace.